Hello class. We are powering on here with our online classes. Again, new to me, so it's my first experience doing this, and hopefully this video finds you well in the middle of this COVID-19 virus. Certainly I'm healthy because I have high energy and I do enjoy lecturing. I would far more prefer to have you here with me in class, but hopefully you are safe and you're engaged in the materials. So we're looking at chapter 12 here, investments, and this is for intermediate 2 here at UNT. This is kind of a digression, if you will, because we're moving back to the asset side of the balance sheet. Maybe I assumed that Accounting 3110 got too filled up with materials, and so they pushed it over to those of us who teach 3120. I guess I just work here, so I will follow the plan. But investments is a very interesting area of accounting, and in some parts of this we'll touch advanced accounting, and this is a slight introduction to what you'll see in consolidations and other accounting and equity investments. So I guess the main gist of this chapter is companies are going to make investments in other companies, in stocks, in bonds, for a multitude of reasons. Let's start with those high-tech companies like Microsoft, Intel, Apple, that just have billions and billions of dollars of cash. I know that Microsoft over time has had over 100 billion in cash. Well, they don't want to just hold that in cash, so they're going to go out and make prudent investments. I think Microsoft's very conservative in their investments, a lot of fixed income types investments. They don't want to lose money, but so they're going to make investments because they're holding all that cash. A second reason a company might make an investment is strategic. And I'll use, I like to talk about Linux because that's where I worked for 11 years. I know the whole inside story. And so we had several investments in companies that manufactured compressors. We had an investment in a company in Thailand because they were low cost, but also we had a joint venture that was 51% owned by Emerson, and the remaining half, 24.5 each, was owned by Trane and by us, competitors. And this factory was in the south somewhere, and it always gave us complete access to compressors. So in the hot summer, air conditioners break down, and you want to make sure you have plenty of compressors because you can make a lot of money selling air conditioning in the summer, and it could be a long lead time if you're buying your compressor from overseas or somewhere else. So you have more control. Not complete control because you only own 24.5% of it, but a lot of influence on how that compressor supply is going to be priced, and you share in the profits at 24.5%. So back to the main point here, companies are going to make strategic investments in joint ventures and equity investments as part of their overall strategy to either supply their business or grow their business. You see a lot of joint ventures around technology. Maybe there's 2 companies that don't want to put all their eggs in one basket, and they'll have other companies in the industry join with them in a joint venture to do some advanced research in a certain area. You see a lot of joint ventures like that. So I look at equity investments as more of a strategic nature for businesses, and gets into M&A, which is a very exciting area of business. Hopefully you'll get involved in M&A at some point in your career. So let's look at investments. So we had 2 types, equity securities and debt securities. And they're going to be accounted for differently. So we're going to start with debt. But we're going to try to get dividends and interest, increase the market price of the securities, and develop ongoing affiliations with the companies. And so equity security, we're going to look at it as owned by the company and accounting for it owned by the company, not as individual investors or mutual funds. So we've seen debt securities. Remember all of that fun we had around bonds payable and the effective interest method, a calculation of interest expense. Well, guess what? We're revisiting that. And I know how fun that was for you before. We're revisiting that from the other side as an investor. So we're going to, as a company, own bonds. And we're going to have all that fun stuff with premiums and discounts. So we have, everything that we learned in bonds still exists. the face amount paid on the maturity date, and there will be interest paid along the way with a debt security. So here you go. The present value, you've seen this before, same calculation. And so here in this example, these are 12% bonds, but and that's the stated rate. Remember how this one's coupon rate, stated rate, nominal rate is 12%. The market rate, the effective rate, the yield is 14%. Guess what? We've invested in these bonds, but they're paying us, we're not paying, they're paying us less interest than the market. So guess what? They're priced at a lower amount. At the end of the life of these bonds, the face value of $700,000 will be paid back to us. We're going to be the receiving end this now, but we only have to invest $666 up front. And so these bonds are sold at a discount. Again, remember all this. If the interest rate is greater than the market rate, they're sold at a premium. Interest rate is less than the market rate, sold at a discount. So maybe it's good, a good process for you to get back into this, because bonds payable will be tested on the final exam. So it's good to know that now. So, but look at this. Remember when we issued bonds and we received cash up front, we had a discount on the bond discount as a debit. And so we received $666, and we had a debit in the bond discount, and we had a credit in the bonds payable account of $700,000. Okay, it's like looking at a mirror. It's reversed now because we're on the other side of it. We are going to pay $666, and the discount on an investment is a credit balance, not the debit balance. Why? We're on the other side of the transaction. We are eventually, if we have our bond, instead of a bond payable, be like a bond receivable, except that we call it an investment in bonds, $700,000. And we're going to do all the same magic that we did with that before. So here's our first entry. We're going to take the effective interest method and calculate the $666 at the market rate, and just like we calculated interest expense on a bond payable, now we've got interest revenue, which is just that 7% times 666. And so there, again, remember this, we calculate this first. How much got paid? $42,000, which is the stated rate, divided by 2, because that's an annual rate. So 6% times $700,000, we're going to receive $42,000 in cash interest, but our interest revenue, because we only paid $666 up front, remember this, our true interest revenue is $4,666, and then the plug, that's how much we're amortizing that bond discount. Remember, in this case, the bond discount starts out as a debit, so it takes a credit to reduce that bond discount, and it'll reduce to zero. We'll amortize it down to zero over the life of this bond if we hold to maturity. And here you go. Remember all this fun stuff. Here's your amortization table. Works just like the bonds payable, except now we are receiving this. And I'll let you, you can look at that in the textbook and follow that. And I'm not going to go crazy on the exam on this, although there might be one or two multiple choice on this. So here is the crux of this chapter. This you will be tested on. This, you've got to know this slide inside and out. Print this slide out, know this slide. This is, we have we have to make a judgment call on our intent. Why did we buy this bond? Why did we invest in this debt security, whether it's a bond or something else? Are we planning to we're going to invest in it, we're just going to hold it all the way to maturity? Like Microsoft with their $100 billion, they might have a lot of bonds that they're just going to hold them to maturity. They're just going to, if we bought these bonds, they're safe, and I don't need the $100 billion because Microsoft's doing so well. They're just going to hold those bonds until they mature. And that's called the held to maturity. Another type is a trading security. What kind of companies are trading securities every day? If you're in the class, I'd ask you this and I'd get some answers. So pause and think about companies in your imagination that would be just everyday trading securities, buying bonds, selling bonds, holding bonds, selling bonds. You know, think about it. And I hope what comes to your mind is banks. Banks have a big portfolio of bonds, and they're holding them for the investors. You can call in my investment firm is J.P. Morgan. So I called J.P. Morgan. I said, hey, I need to buy a treasury. Man, they got it there, and they can trade it in seconds almost. And they'll ask me, how much do you want? What rate you're looking for? What term? They have a whole portfolio of bonds. So they're buying bonds and then reselling them, and that's their inventory. If you think about it, they have and they call it that. We have an inventory of corporate bonds and treasuries and things that they can resell. So they're buying and selling treasuries every day. So they're clearly in this category trading. They're trading these every day. And then finally, we have available for sale. It doesn't qualify for held to maturity, and it doesn't qualify for trading. I don't have any experience with this. I think it would be really hard to convince your auditor, and even maybe yourself, that these are truly available for selling. I guess they're not trading. The best definition, they're not trading, they're not completely held to maturity. I think your auditor is going to try to push you into one or the other of these categories. And the accounting changes, as we see here. This is about, let's start here first. What the FASB actually wants is for all of these investments, every balance sheet to be recorded at fair value. The FASB has a strong desire to put all of these at fair value. Now, there's been a lot of pushback from firms because of the volatility of some of these investments trading up and down all the time. And if I'm holding it for maturity, the argument is, why do I gotta put all these changes in fair value affecting my income statement every single time I report? And so their pushback is, I don't think that's right for us, doesn't reflect our intent, because at the end of the term, I'm gonna get the principal back, even though there were a lot of volatile changes over time. I'm just in for the long term. If I have a 10-year treasury, I'm gonna hold it for 10 years, and then the last day of that 10th year, I'm gonna receive the face value back. And so that's held to maturity. So why do I have to record all the changes in fair value? And the FASB agreed with that. And so for held to maturity, we do not record the fair value of those bonds on the actively traded markets. What we do is we just hold to the amortized cost, which is whatever the carrying value is, the net book value, if you will, after we amortize either the bond discount or the bond premium, just like the opposite side of bonds payable. So whatever that calculation on this table ends up, that's the amortized cost at the end of each year after we've amortized the bonds payable, the bond discount account. And so held to maturity, no, that's what you've got to memorize here. There's a lot of, there could be some memorization. I'll try to help you with the logic behind it, but basically memorize. Held to maturity debt securities, they go in at amortized cost, and even if there's some unrealized gains and losses, since there's no intent to sell this ever, those unrealized gains and losses are not recorded. Okay, trading securities, the opposite. We're buying and selling them every day. And so at any point in time, we may have a whole bunch of bond investments in our inventory, if you will, if I'm a bank, and we do recognize at the end of every reporting period the fair value of all of those on the balance sheet, and any changes in that fair value from when we purchased that security or from the last reporting period, it goes through net income. Hits net income. Trading securities. All right, here you go. Not my favorite one. Available for sale is going to be more like pension accounting. Remember pension accounting? We are going to put them on at the fair value, like we put the PBO and pension at the fair value, and the changes in the PBO, though, did not hit net income. They went into what's our bucket in equity, other accumulated other comprehensive income. Remember, I call it a big bucket. We put stuff in there that the FASB has said will not hit the income statement right now. It will hit the income statement later. And so for here, the changes in fair value are recognized in other comprehensive income, and and they'll come out when we sell the stock, so when it's realized. And so, again, just to summarize, held to maturity, fair value is not recognized, changes, therefore no changes in fair value hit the income statement. Trading security, we recognize the fair value, and all changes in the fair value go through the net income statement. It will affect positively or negatively net income. And then available for sale, the changes are recognized in other comprehensive income, so that we can put these on the balance sheet at fair value. So again, I think you know all these things. So if we've got a held to maturity, we've got a maturity date to principal, that will be paid to the investors at the end, and the interest is paid along the way. So some of those same things. So again, we've talked about this change in fair value ignored, as long as it's viewed as temporary. Now, if we believe there's a permanent reduction in the fair value, and that has to be over an extended period of time, then we have to recognize it. And that's a judgment call. I know that Ernst & Young at Maytag, if it was lower, if the fair value was lower than the amortized cost for more than a year, they said, you got to recognize that now. And a lot of times we were trying to argue, no, it's only temporary, it's going to come back up. Don't do that. So there is a piece, kind of like, it's like lower of cost of market on inventory, if you go back to accounting, intermediate accounting for assets, that it's a little bit like that. So if we know it's a permanent reduction, we will recognize that. Trading securities, we have active buying or selling. Sometimes the holding period is measured in hours, days, even not even months, just a short period. So JP Morgan has all these securities, they buy them to resell them. So they're holding them not to make money on their own account, but to sell them to investors. That's what they're in the business to do. And guess what? Trading securities, I'm going to change that. Typically reported, always, I want you to think, if it's a trading security, we're going to exchange that into cash before the next year is over. So I would think of trading securities as being a current asset. And if you see that on an exam, a trading security is going to be listed as a current asset, not a long-term asset, because we're going to be buying. Held to maturity, what would that be? Long-term asset if the principal is not due for another 12 months. And so unrealized holding gains are recorded in net income, and it's carried at fair value on the balance sheet. And so no effect on comprehensive income here, because we're always recording the changes in fair value on the net income. And the cash flow statement, which we'll see later, it's classified as an operating activity, because that's our business and operations. For non-trading securities, it's going to get into a financing or an investing activity. And available for sale, this available for sale, reported at fair value on the balance sheet. Gains and losses go through other comprehensive income. So that's debt securities. And again, I said the accounting for equity is going to be different. A lot of times the business decision to own an equity security is very different than owning a debt security. There may be some strategic reasons to own the debt of another company, but generally that's going to be more as a holding place for large sums of cash that we don't want to hold as cash. And so, especially with these high-tech companies that have large amounts of cash on their balance sheet. And usually if you look at their balance sheet, you'll see cash, big amount, you'll see another line item, short-term investments, and even another one, a lot of times called long-term investments. You have to add those three up to know how much actual investment assets do these companies have, and again, significant amounts. So equity, for debt we have interest. For equity we have to think about dividends. When we own an equity investment and they're paying dividends, we're going to receive dividends from that company. And just like with debt, the fair value of these investments are going to go up and down over time. And again, the FASB wants all these fair value changes to be reflected on the income statement. But there's some pushback from companies, like with debt, and so we have some categories. And so the three categories we're going to talk about here depends on how much our ownership percentage is. And if you earn, this is a general, this is the starting point for this evaluation. When you take advanced accounting, there's going to be a lot more discussion, a lot more criteria that you're going to look at on whether you count it in these three categories. But generally speaking, and especially for this class, if the company owns less than 20%, we assume that we do not have a significant influence on that business. Therefore, we cannot really influence their operations. We're just a passive investor. So the accounting is going to take place like a passive investor. We're going to record the changes of fair value through net income. So this would be just like trading securities under debt. Same thing. Every quarter we'll look at the fair value of this. An example, at Lennox, as I said, we owned a compressor manufacturer in Thailand. We only owned about 10% of that. And so every quarter I would have to go out to the the stock exchange of Thailand, and see, hey, at the last minute of the last day of the quarter, how much was our investment stock price? And guess what? Sometimes there were surprises. And it was never fun, because my boss would call me and say, hey, where's this $2 million charge from? I said, well, that's from our investment in our Thailand compressor. He said, well, why couldn't you forecast that? You know, because we always want to forecast the future to help the CFO in talking to analysts. I said, man, I didn't know it was going to drop. So a lot of times, even in the last couple of weeks of the quarter, we're kind of tracking that, so I could call the CFO and say, hey, looks like we're going to take a charge, or a gain. If the value goes up, it could be a gain. When we had a large gain, funny part is, and that even I didn't forecast it, I never got a phone call. You know, I only got a phone call when there were charges against that, and that's just the life of a chief accounting officer right there. So now, if the investor owns 20% and 50%, let's go to the last one. If the investor owns more than 50%, that is complete control, because that's just a voting power. We can vote, we can control the entire operations. And so when we own more than 50%, we have complete control. And therefore, we consolidate the financial statements. Certainly not the scope of this course, the scope of advanced accounting. For example, at Lennox, we had about 200 general ledgers and about 25 different currencies, and we wholly owned all of these subsidiaries, and we had to convert and consolidate all of these subsidiaries into one set of US dollar financial statements. And by the way, we had 5 days, you know, so, and there are systems that helped us do that. So if you own more than 50%, you're consolidating everything, so it's just one income statement that includes all the numbers from all the wholly owned 100% on or more than 50% on subsidiaries. And there's a little thing called minority interest. I won't get into that here. But again, this is advanced accounting here. It's I love this. I love consolidations. It's complicated. It will make your head spin a little bit, and so that's what you have to look forward to in advanced accounting. Now, here we are in the middle area. Well, we own more than 20%, but less than 50%. Now, we don't control it completely, but we have influence. For example, when Lennox owned 24.5% of this compressor manufacturer, and Train, our competitor, owned 24.5%, and Emerson, who makes compressors, they're experts in this, they own 51%. Well, there's a board meeting. We had a lot of influence on whether we're going to restructure that business, what's happening with the pension plan for employees, how much are we going to produce in compressors in the next year, how much do we need? Lots of conversations and significant influence. So what we do here is kind of a tweener. We do not do fair value through net income. And a lot of these equity method investments, it would be hard, they're not traded on like that. Compressor manufacturer in the South was not traded publicly. It would have been very hard to know the fair value of that business. And so it's an equity, what we call is an equity method investment. And that's a piece that certainly I will want to test you on, and certainly within the scope of here, 3120. And so let's look at the equity method. So between 20 and 50%, decisions can be swayed in the direction that the investor desires, because and sometimes they might look for funding from us as well. And the investment is accounted for under the equity method. So consolidate if we own more than 50%, combine all the individual elements of the subsidiary statements into one set of financial statements, as I discussed with Linux. And I'm going to talk about how the equity method works when we work our problems. I think that'll be a lot better choice for you. But I will just summarize it like this. In the equity method, if we own 25%, we're going to record 25% of that equity method investor's net income as our net income. And when we pay dividends, we're going to reduce that. So I'll provide you with more information on that when we work problems. So hey, thank you guys for being engaged in this lecture, and we'll start working problems now. Thank you.